are not bound to increase rates at every meeting because that is not required given our inflation outlook.
A bit surprising. I think it comes down to, we've been saying for a long time that the framework should not change.
I'm in absolute disbelief that what's happening on the regulatory front, with due respects to the regulator, we all owe respect to them, their wisdom. Are they in the same world as we are in?
I think it was a mistake. The whole world is going through a major recalibration in terms of monetary policy, and India does not live in a vacuum.
We are closing down with a big cut. 950 points in the Sensex, Anuj, 330 points in Nifty. This is the third such Friday in a row.
This is how capitulation looks like. That's the one point you were making in the morning, that final capitulation phase is when stocks like Reliance start to fall. This process is very painful, but it's right now the process which is going to lead to the market forming perhaps a durable bottom.
When central banks don't deliver an expected rate hike, they are usually greeted by exhilaration in the markets. Not this time. Governor Patel's no-hike policy was greeted with sinking stock markets and a falling rupee. Only the bonds cheered, and that mutely. What probably rattled the currency markets was the Reserve Bank's assertion that its mandate is inflation targeting and exclusively inflation targeting. The assertion somewhat left the market wondering who is in charge of stability in general and the external sector in particular. But first, the key announcements. Firstly, the Reserve Bank has cut its inflation forecast, a signal that higher crude oil prices and a weakening rupee may not have that much of an impact on prices, at least not as much as the market estimated. However, the Reserve Bank's stance has been changed from neutral to calibrated tightening. So rate hikes could be around the corner, even if not right now. Thirdly, shares of non-banking finance companies nosedived, and that because the Reserve Bank of India Deputy Governor Vishwanathan pointed out that new rules over asset liability matches and mismatches of NBFCs will be written shortly. With the debt market already under pressure, this statement probably sparked off the sell-off in equities. But to repeat, what may have created a flutter in the money market is the Reserve Bank's repeated insistence that inflation targeting remains its exclusive goal. The RBI governor emphasized this many times, saying this was a legislated mandate and one that the central bank cannot veer away from. This may have taken money markets by surprise because the MPC has an inflation targeting mandate, but the Reserve Bank was historically understood to be a full-service central bank that has financial stability as its core mandate. Before we bring in the experts, here are the key highlights from the press conference addressed by the governor and the deputy governors.
RBI's long-standing policy, underscored by both Dr. Acharya and I, that the monetary policy is exclusively focused on the inflation targeting, and that is the legislated mandate. Prior to this, we had two rate hikes in the space of literally 2 months, and today's stance of calibrated tightening essentially means that in this rate cycle, a rate cut is off the table, and that we are not bound to increase rates at every meeting because that is not required given our inflation outlook and forecasts at this point in time. As new data comes in, we would look into changing our policies accordingly. But the calibrated tightening is the appropriate stance at this point in time.
The NBFC sector overall is quite strong, and the regulatory and supervisory framework is robust. So we are looking at strengthening. There is an ALM guideline for them, but we are looking at strengthening them so that we can avoid this rollover risk going forward.
Well, to discuss the policy and its implications, joining me now are Mr. P.K. Gupta, Managing Director, State Bank of India. We are also joined by Pranjal Bhandari, Chief India Economist at HSBC, and B. Prasanna, Head Global Markets Group at ICICI Bank. Gentlemen and lady, thank you very much for joining me. Well, Pranjal, let me come to you first because of probably the philosophical confusion I had. the Reserve Bank repeatedly said, or the governor repeatedly said, that their exclusive mandate is inflation targeting. And I was watching the rupee screen at that time. The moment that was said, the rupee, which had already weakened to 73.97, fell further to 74.12. Is this a philosophical confusion that one thought the Reserve Bank would be responsible for the external sector as well, and somehow it seemed to abdicate that responsibility?
Right. Look, I am surprised that the RBI did not hike rates today. I was expecting a rate hike. But I don't think it's inconsistent. I think they've been very clear that they are inflation targeters. They look at inflation. Interest rates is an instrument to deal with inflation. FX intervention is an instrument to deal with volatility in the FX markets. So in that sense, there is no disconnect. I think the disconnect lies elsewhere. The disconnect lies in inflation forecasts. Our forecasts for the remainder of this year and next year are much higher than RBI's forecasts. RBI has done a huge cut, 60 basis points for the near term and 20 basis points for later. And I think that is where the disconnect lies. I think at the heart of this disconnect is also how it's reading food and fuel. I think it believes that this food disinflation will continue for longer. I think what it misses out is that if food disinflation continues for longer now, then food prices will become very low, and next year food inflation will have to grapple with a low base. So there'll be more pressure for headline inflation. I do believe RBI is underestimating headline inflation in FY20.
Okay. Well, I take that point, but Pranjal, I will revisit this issue, of course, but that still doesn't answer why the rupee fell so much. Exactly as the Reserve Bank was explaining, that it is inflation targeting central bank.
Yes, well, that's very hard for me to tell, but I think there was an understanding in the market that rates will also be used to curb further depreciation in the rupee. And I don't think it was a right assumption that the markets were going with. I think the RBI was very clear always that they are a flexible inflation targeter. You can only use one instrument for one objective. The instrument of interest rate is being used for inflation. They can't use it for two objectives. I think that is something which the markets did not realize, and it's come as a shock therefore today.
Well, it's certainly a variation from what central banks have historically done, even if they have not said it. They've used interest rates and used all policies for all goals, but this one has defined his goal more exclusively. First, your key takeaways, Prasanna, from the policy action and the statement.
So, Latha, I think you got the first point right. I think the most important takeaway from the whole policy is the fact that the RBI has clearly reinstated its inflation targeting framework, and while not admitting to the fact that interest rates will be used as a tool for supporting currency at any stage. So I have my thoughts to the whole argument is that a legislative mandate does not really override basic economics, and we all know about the impossible trinity, which is basically your capital flows, monetary policy and currency are interlinked to each other. So world over, there is an expectation that notwithstanding an inflation targeting framework, interest rates typically are also used in the sense when you react because you're not living in a vacuum, right? You're living in a relative world where what other countries do also impact your flows and your macros. So to that extent, I think the market was expecting interest rates to be used partly to support the currency. And so I do agree with Pranjul, however, on the inflation estimate that they did take into account cognizance of the fact that the realized inflation in the first quarter came lower substantially, so they have revised it lower going forward. But what was left unanswered was the fact that the rupee depreciation and the appreciation in crude oil over the last 2 months would leave a significant dent in the future inflation trajectory. So I don't think maybe our estimate is a slightly much higher trajectory than what the RBI is projecting currently. So to that extent, for me, the biggest takeaway was the fact that they have not alluded to interest rates to be a tool for supporting the currency. The second biggest takeaway for me, Latha, was the fact that they are, and rightly so, very deeply concerned about the dislocation dislocation in the corporate bond market and the NBFC funding space. So I see a lot of coordination between Reserve Bank and the government in tackling the funding crisis arising out of the NBFC scenario. So that's a very good thing that's come out of this policy.
Okay, but I guess the market was expecting, and I would assume wrongly, that because this is a monetary policy statement, that some succor will come for the NBFC sector. What they got was the Deputy Governor reading out the Riot Act and saying that, you mismatched your assets and liabilities. Do you think that, now if you were an NBFC investor, I'm probably asking the wrong person, do you think now we should expect tighter regulations, if anything, and NBFCs are going to face a harder time, Prasanna?
So, Latha, I think the RBI might have been short on actions as far as this policy is concerned. But you should also realize that the liquidity bazooka has actually been released even prior to the policy. They didn't even wait for the policy. They actually did the false CR increase from 13% to 15% hardly 5 days ago, and they did the open market operation calendar just hardly 3-4 days ago. So they are clearly mindful of what actions are required, and once they are convinced that they want to be announcing an action, I don't think they are wasting any time to announce it. So that apart, I think the crux of the problem as far as NBFCs are concerned have been rightly identified by the Reserve Bank, and I think that is the ALM policy of these NBFCs. I mean, equity market might not have liked what they heard from the Reserve Bank, in the sense that they are actually telling the NBFCs to they're going to be coming out with guidelines, possibly going to be much more harsher on the ALM gaps that they are possibly allowed to be taking. But from a systemic perspective, I think that is exactly the crux of the problem, and it's good that RBI has identified that, and probably any guidelines which comes in that perspective might do something good for the long-term sustainability of the NBFC sector.
Oh yes, sir. And of course, one of the unaddressed issues was liquid mutual funds, but I guess this was not the occasion, and the RBI would perhaps want the SEBI to handle the mutual funds lack of corporate repoing or a lender of the last resort problem. But now let me come to the biggest banker here. Mr. Gupta, first, sir, your key takeaways.
No, I think as Pranjul and Prasanna mentioned, I think the market assumed the rate hike primarily on account of the crude price increase and also the expected inflation that it would have brought in actually. So there obviously the RBI's own projection of the inflation going forward seemed to be much lower. My slightly different take on this is that RBI, I think the governor did say that they have already done 2 increases. They probably feel that, those increases in the high interest rates that they have already executed, they are working. Okay. So the undershooting of inflation in the previous quarter, plus going forward, if they really believe that the inflation is going to be lower than what they had expected in the last policy itself, then there is no need to increase the rates. I think if you look at it, if they are now expecting that the inflation is going to be lower than what they are projected, and to take that into account, they have already increased the interest rate. So there was no logic to increase the interest rate further. The market did expect, I think, primarily on account of the forex and the crude price increases. So which again, I think they clarified that probably interest rate is not the tool they are going to use. Maybe they will have some other tools to use.
But no,
so, I mean,
Mr.
volatility,
Gupta,
their stated policy has always been to take care of the volatility.
Yeah, Mr. Gupta, but as a man who has to price money on a daily basis, price money for depositors and price money for your borrowers, are you not left in a state of confusion, which is what some other bankers told me, by the way, when the Reserve Bank in the August policy increased its inflation forecast from, for March from 4.6 to 4.8 and added a 5% for the first quarter, it said it is at neutral in terms of a stance. Now it has cut the inflation target and it has said that it is tightening. Is not this a policy confusion? What will your next move be? Will you raise deposit rates or will you lower them? Will you raise lending rates or lower them?
No, I think as far as the deposit and lending rates are concerned, okay, apart from the policy rates, see, as you know that, in terms of borrowings from the Reserve Bank of India or at the policy rates is very low actually. We are really dependent on our deposits for funding loan book. So that is a function of the liquidity and the deposits that flow into the bank also.
Okay.
So liquidity was an issue. I think about a fortnight ago, we did see some tightening of liquidity. They have taken enough action, all that 2% false CRR as well as the OMA calendar. So that did release a lot of liquidity into the system. In fact, today also, if you look at it, I think on a system-wide, we are liquidity surplus. So I think if the liquidity continues to be all right, I see no reason why the banks should really be increasing the interest rates. Okay. And again, if you look at the whole spectrum of banks, see, there are some banks who probably have a little bit of tightening of liquidity, but most of the system still seems to be surplus, and I don't think there is any real concern there as far as rates are concerned.
Okay. Okay, Prasanna, I want to get into the bond market discussion as well, but before that, I have to take a break. I just want one question addressed to you before I take that break. What do you think is the next move for the banking sector? Will deposit rates go up? And if yes, how soon? Or will they not go up at all in the near future?
So I think the deposit rates is going to be a function of the overall liquidity in the system. Like Mr. Gupta was pointing out right now, seems to be that enough actions have been taken by the Reserve Bank to supply liquidity which is required at the current point in time. But we should also understand that going forward, it's going to be busy season policy, a busy season where there's going to be a lot of credit growth happening, as well as there is a season when the currency in circulation, actually you see a seasonal hike in the CIC number. So from that perspective, I think system liquidity is going to take a hit, and what would be of importance is whether durable liquidity is being provided by the Reserve Bank to sufficiently compensate for that. If it is not really the case, then I would presume that it will be the responsibility for each of the banks in the banking system to, their ALCOs to meet and decide and figure out what kind of deposit rates that they should be quoting. So I would expect deposit rates to go up if enough liquidity is not provided in the system.
Okay. Well, let me take a break now. I still have a little more questions, some more questions for all of you on how you see the inflation trajectory and how you see the Reserve Bank's rate trajectory from here on, and hence the impact on bonds and rupee. We are back in a jiffy with our guests.